Picture this, a Wall Street trading floor, but instead of frantic yelling, there's an eerie silence. The only sound? The hum of servers, trading at lightning speed, controlled by AI. Is this the future of finance? Are we handing over our economic destiny to lines of code? The stock market, once human-driven, is now the playground of algorithms. These AI programs analyze data, spot patterns, and execute trades at warp speed. But this world of automated trading has its critics. Concerns about transparency, fairness, and potential errors persist. Did you know over 70% of US trades are by algorithms? Events like the 2010 flash crash show the risks. Is AI secretly controlling the stock market? Let's uncover the truth, one algorithm at a time. First, let's give credit where credit is due. AI brings some serious strength to the stock market party. These algorithms process information at speeds that would make even the most caffeinated trader's head spin. We're talking nanoseconds here, folks. Some AI systems can process up to 10,000 transactions per second. This speed advantage allows AI-powered systems to react to market movements almost instantaneously. Remember what happened in 2008 with the housing crisis and the subprime mortgage debacle? The global financial meltdown nearly brought the world economy to its knees. It was a time of unprecedented turmoil. How does AI learn from such events? AI learns from past data by sifting through mountains of information, looking for patterns and historical rhymes. But what happens when the unexpected strikes? When a black swan event throws the financial world into chaos, AI's reliance on historical data becomes a liability. So AI has its strengths and weaknesses, just like any good Wall Street tycoon, right? Are we doomed to be pawns in a game controlled by algorithms we don't understand? How does that work? Are these AI-powered tools accessible to retail investors? Algorithmic trading now accounts for over 60% of all trades in the US stock market. AI brings efficiency and cost savings, but also new dynamics to navigate. The rise of AI in the stock market promises efficiency and speed, but it also brings challenges. One major concern is the lack of transparency. Investors and regulators are often left in the dark about these complex systems. High-frequency trading algorithms are often secretive, making regulation difficult. This opacity creates suspicion and mistrust among investors. Algorithms can behave unpredictably, contributing to market volatility. The flash crash of 2010 and the Knight Capital incident in 2012 are prime examples. As AI becomes more sophisticated, the potential for unforeseen failures grows. We must balance the promise of AI with an understanding of its risks. Regulators, investors, and technologists must work together to ensure market stability and fairness. So what's an investor to do in this brave new world of algorithmic trading? The first step is education. Learn about different trading algorithms and their market functions. Understand how they work and the safeguards in place. AI isn't all doom and gloom algorithms gone wild. One of its most promising applications is in market surveillance. Imagine an all-seeing eye, constantly scanning for suspicious activity, sniffing out insider trading and market manipulation. AI's real-time data analysis makes it the perfect watchdog. Wall Street isn't just about numbers and algorithms. There's a human element involving gut feelings and intuition. AI can't replicate that. Can an algorithm understand market emotions? Until then, human intuition still holds sway. Remember all that talk about AI being a black box, operating in secrecy and making investors nervous? Imagine a world where algorithms explain their decisions in plain English. This kind of transparency could build trust and confidence in the market. Possible threats. The rich get richer algorithmically. Now, let's talk about the hedge fund manager with a supercomputer in his basement. This isn't just a hypothetical scenario. It's a reality unfolding right now. AI in the stock market could exacerbate existing inequalities. According to a 2020 report by the World Economic Forum, the wealth gap has been steadily increasing, and AI could accelerate this trend. Sophisticated algorithms are expensive to develop and deploy, concentrating access in the hands of Wall Street titans. Large financial institutions are investing billions in AI, leaving smaller firms struggling to keep up. Hedge funds with deep pockets invest heavily in advanced technologies, giving them a significant edge. For instance, Renaissance Technologies, known for its use of AI, has consistently outperformed the market. This could create a scenario where the stock market becomes a rigged game, skewed in favor of those who can afford the best technology. High-frequency trading, often powered by AI, can disadvantage traditional investors. Unless we ensure AI is used responsibly and ethically, we risk creating a financial system that is both unfair and unsustainable. The European Union has already started drafting regulations to govern AI use in financial markets. Data from the Federal Reserve shows that the top 1% of households own more than 50% of the stock market, a disparity growing with the rise of algorithmic trading. As we move forward, it's crucial to address these disparities and ensure that the benefits of AI are shared more equitably. This will require collaboration and regulation to create a more balanced financial landscape. Recommendations: how to level the playing field. How do we prevent AI from turning the stock market into a playground for the ultra-wealthy? Promote greater access to AI education and resources. Fund AI research and development, and train the next generation of AI experts. Encourage open-source AI platforms to democratize AI, giving everyone a fair shot at financial gain. By making AI more accessible and affordable, we can level the playing field. So, is the future of finance a human-AI tango? The answer is complicated. AI is playing an increasingly influential role in financial markets. But human traders aren't becoming obsolete. The future involves a complex interplay between human intuition and AI, a delicate dance between gut feelings and data-driven insights. Keeping an eye on current developments. The rise of AI in the stock market presents both exciting opportunities and challenges. It can make the financial system more efficient and accessible, but also increases the risk of volatility and manipulation. Monitoring and regulation are essential. As we keep an eye on new technologies, we must also keep our minds on the ethics that guide us. The rise of AI in stock trading isn't just a technological revolution, it's an ethical one too. The ethical implications of AI in stock trading are profound. We need to consider how these algorithms make decisions and who benefits from them. Are we creating a system that perpetuates existing inequalities, or can we design one that promotes fairness and inclusivity? It's not just about profits, it's about responsibility. But with great power comes great potential. AI-driven market predictions can revolutionize our financial systems. They can provide unprecedented insights, reduce human error, and make trading more efficient. However, they also pose risks, such as over-reliance on algorithms and the potential for market manipulation. Balancing these benefits and risks is key to harnessing AI's full potential. As we stand on the brink of this ethical frontier, our choices will shape the future. By keeping ethics at the forefront, we can ensure that AI not only advances our financial markets, but also serves the greater good. So let's not just keep an eye on the code, but also on the principles that guide its use. Together, we can build a future where AI works for everyone, creating a more equitable and prosperous world. Thank you for watching, and until next time, stay curious and stay ethical. Please like and subscribe for more content, and don't forget to hit the notification bell so you never miss an update.